What is short selling? Understanding short selling in financial markets. Are you ready to discover the mind-boggling secret that Wall Street insiders don't want you to know? Brace yourself, because we're about to unveil the captivating world of short selling, a financial strategy that will challenge everything you thought you knew about making money in the stock market. In this video, we'll dive deep into the intriguing realm of short selling and explore its inner workings in the financial markets, from the shocking tales of market manipulations to the risky bets that can make or break fortunes. We'll uncover the hidden side of investing that few dare to discuss. Get ready for a front row seat to the adrenaline-pumping world of sell high, buy low, and discover how short selling can turn the tables on traditional investment wisdom. But why should you stay till the end? Because understanding short selling is not just for financial wizards and Wall Street elites. It's crucial knowledge for every investor. By the time this video concludes, you'll have the insights and tools to navigate the unpredictable terrain of the stock market with confidence. Whether you're a seasoned trader or a curious beginner, this journey will empower you to make more informed decisions and potentially uncover unique opportunities in the financial markets. Get ready to redefine your understanding of investing and stay tuned for a whirlwind of knowledge that could forever transform your financial future. Short selling at its core is a financial strategy where an investor is betting on a stock price's decline. It sounds rather counterintuitive initially, doesn't it? After all, most of us are familiar with the adage, buy low, sell high. In short selling, the strategy essentially becomes sell high, buy low, a mirror image of the usual stock investment process. At this point, you may be wondering, how does someone sell a stock they don't own? Well, this is where the concept gets interesting. In a short sale, the investor borrows shares of a stock from a broker and sells them immediately at the market price. The idea is to buy them back later at a lower price, return the borrowed shares to the broker, and pocket the difference. During financial crises, short selling often takes center stage, attracting significant attention and debate. It can act as a magnifying glass, intensifying market downturns and adding fuel to the fire. Critics argue that short selling exacerbates market volatility, leading to a panic selling and further price declines. Proponents, however, contend that short selling serves as a crucial mechanism for price discovery and can expose overvalued assets, contributing to market stability in the long run. The global financial crisis of 2008 provides a prime example of the controversial role short selling can play during turbulent times. As the crisis unfolded, some market participants engaged in aggressive short selling of financial stocks, contributing to the downward spiral in their prices. This in turn eroded investor confidence and weakened the stability of financial institutions. In response, regulators in various countries imposed temporary bans or restrictions on short selling to calm the markets and restore confidence. The debate over whether such measures are effective in mitigating financial crises remains ongoing. While short selling can amplify market downturns, it also serves a vital function by acting as a check against overvaluation and exposing weak spots in the financial system. During times of market exuberance, when asset prices reach unsustainable levels, short sellers can identify and exploit these vulnerabilities. By betting against overvalued stocks or sectors, short sellers can provide a reality check to the market and potentially help prevent or mitigate the impact of speculative bubbles. It's worth noting that short selling is not solely responsible for financial crises. It is one piece of a larger puzzle, and its impact is intertwined with various factors such as excessive leverage, poor risk management, and systemic failures. Understanding the complexities and interconnections of these elements is crucial for comprehending the role of short selling in financial crises. Regulators play a crucial role in balancing the potential risks and benefits of short selling, especially during times of market stress. They aim to strike a delicate equilibrium, allowing for the efficient functioning of markets while safeguarding against abusive practices. Measures such as short sale reporting requirements, uptick rules, circuit breakers, and temporary bans are some of the tools regulators employ to maintain market integrity and stability. Let's dive into a simple example to clarify this. Imagine that company XYZ stock is trading at $100 per share. A short seller, believing that XYZ stock is overvalued and will fall, borrows 10 shares and immediately sells them, receiving $1,000. Or 10 shares by $100 per share. Later, when XYZ's stock price falls to $50 per share, the short seller buys back 10 shares for $500 and returns them to the broker. The short seller makes a $500 profit from this trade. However, there's a catch. The potential loss in short selling is theoretically unlimited. If the price of the stock rises instead of falling, the short seller might have to buy back the shares at a much higher price, resulting in a loss. In our example, if XYZ's stock price rises to $150 per share, the short seller would have to spend $1,500 to buy back back the shares, resulting in a $500 loss. Short selling plays a vital role in the financial markets. It contributes to market efficiency by adding liquidity and providing a check on overvaluation. Despite the potential benefits, short selling is often met with criticism and skepticism, as it can accelerate market downturns and can be used for market manipulation. The process of short selling involves various players: the short sellers, the brokers from whom they borrow shares, and often the actual owners of the shares who lend them out to earn extra income. Each player has a role in the financial market ecosystem, and each has its motivations and risks. For short sellers, the motivation is profit from a potential drop in a security's price. Short selling can also be used as a hedge, serving as an insurance policy against other investments. If an investor has a substantial long position in a particular stock or sector, they might short sell similar stocks or sectors to offset the potential losses in their primary investments. Brokers, on the other hand, earn lending fees from loaning out the shares to short sellers. Additionally, the actual owners of the shares who lend them out often earn extra income in the form of interest on the loan. While it can be profitable, short selling comes with a high degree of risk and complexity. Not only are the potential losses theoretically infinite, but there's also the risk that the broker may request the return of its shares at any time in a buy-in. Furthermore, short sellers are responsible for paying any dividends or other distributions for the stocks they've shorted, adding to the potential costs. Despite these risks, short selling remains a common strategy used by individual traders, hedge funds, and other institutional investors. It's a practice that's woven into the very fabric of the financial markets. The key is to approach it with knowledge and caution. A well-regulated market needs mechanisms to express both positive and negative views on asset values. As such, short selling is an integral part of the financial markets. However, its controversial nature means it's often the subject of scrutiny and regulatory changes. Understanding the ins and outs of short selling, therefore, not only helps individuals engage in the practice responsibly, but also contributes to the broader comprehension of how our financial markets function. To conclude, short selling is a double-edged sword, carrying the potential for high returns and significant losses. It is not a strategy for the faint-hearted, but it can be a useful tool for those willing to take calculated risks. Whether you engage in short selling or not, understanding this concept is a valuable part of financial literacy.